Hey, it's Jason Waters and welcome back to the channel. Today I want to talk about mortgage points, a couple different kinds that are out there, whether you should use them or not. So first of all, let's talk about a long-term buy down of a mortgage rate. Those are called points. You can pay points to buy down rate for the entire life of the loan, no matter what term of loan you have. Be a 30-year loan or a 15-year loan, even a 10-year loan. You can buy the rate down for the entire term of the loan. Should you do this? It really depends on how long you want to stay in the home. If this is your forever home and you think rates are at a relatively low spot, then yeah, sure, buy down the rates. They are tax deductible after all, so that is another benefit to it. But if you're going to move, it may not make as much sense. I will tell you that in the current market we're in, as of this recording, of paying some points are usually expected by lenders just based on where the rates are. We're at an environment right now where rates are expected to come down significantly over the next year or so. So lenders are really trying to recoup their money by charging a little bit of points up front because they know they're going to get paid off. There's another thing to look at out in the market right now. They're called temporary rate buy downs. There's two ways to do this. You can temporarily buy down the rate via seller paid closing costs. Here's how this works. Let's say your rate without a rate buy down were to be 7%. If we can get the seller to give you enough seller credits, oftentimes by paying more for the home, and it costs around 2% of the loan, then we can take your loan from 7% this year to 5%. Instead of 7%, we take it to 5%, and then 6% in year two. So it's beneficial for you in year one. You've paid 2% for a 2% reduction, and in year two, you're really making money. But pay 2% for a 2% reduction in year one. The reduction in year two is free, and then in year three, you go back to what the note rate is. Now, here's the really important thing to know about these 2-1 buy downs. It is almost impossible to lose because let's say rates came down quicker. We're at 7% now, you got your 2% buy down to 5%, and rates dropped to say 6, and you said, Jason, I want to refinance. If you refinance and you haven't used all of that buy down, the amount that's kind of in an escrow account goes directly to pay down principal of your loan. So you get instant equity into your home. So you really can't lose. If rates stay up, you make money in year one. If rates go down quicker, you get more equity in your home faster. So I really like the 2-1 buy down paid by sellers. There's another buy down that some people might want to consider, and it's called a 1-0 buy down, where you pay for a temporary rate buy down on your own. I don't think it's as good of a deal, but I think it depends on your situation. For example, if you really want a lower payment right now and have some funds to do that, it may work for you. But I think for most people, I would go with the 2-1 buy down, or I would just go with whatever rate is out there and save the money for other expenses or to make your payments in the future. Well, that's all I have for today. I hope the conversation or discussion around what long-term points are and what temporary points are, rate buy downs, is helpful. Reach out to me on social media. Like the page so you can continue to get the updates. Find me on Facebook, give me a call. Love to help you in any way. Thanks.